Hi, it's Barry Bannister, equity strategist at Stifel. Our note is called Pregnant Pause. Does flipping correlation point to a cyclical rotation for the S&P 500? The issue that I believe we face is that we either get global reflationary traction or bust. The S&P 500 has no upside without global GDP, and in this note I will try to illustrate why that might happen, global GDP, and what it would mean as far as equity investing. On Exhibit 1, what I show is correlation ribbons on the top against three macro variables. Here, the rolling 52-week correlation of the S&P 500 price to the dollar. Here, the correlation to commodities. And here, the correlation to the 10-year yield. For example, from second quarter of 14 to about second quarter of 15, from A to B, we had rising and positive correlation to what was historically a peak, very high levels of correlation approaching 1, where the S&P rose as what happened? The dollar rose. On the middle chart, you see that the correlation went from positive to negative, and it went to a bottom close to 1. Of negative correlation to commodities, which fell from A to B, mid-14 to mid-15. And what that tells you is that essentially the market relished weaker commodities. It had negative correlation, went up when commodities went down. And then here, lastly, mid-14 to 15, you had from positive down to sharply negative correlation. With the 10-year yield. The 10-year yield fell A to B, and the market rose with that phenomenon. Now, if I were to describe an environment that would be absolutely perfect for growth stocks and consumer stocks, it would be the dollar up, commodities down, and the 10-year yield down. And in effect, that's what we had, but that was then, this is now, and sometimes the best indicator of price direction is, prices. So let's look at what's happening now. Using the same charts, we're now at 0 on the dollar S&P correlation, meaning if it flips over to negative correlation, a stronger dollar would cause the market to fall. We are at positive correlation to commodities and positive correlation to the 10-year yield, which means that if commodities fall and the 10-year yield falls, it would be greeted as deflation, destructive, and the market would fall because it's got this correlation. So what we need is, the market needs is the dollar to come off the boil, commodities to bounce, and the 10-year yield to get traction and rise. Were that not to occur, I don't think stocks can go up at the S&P 500 level. Fortunately, we're seeing some signs that some positive developments may be occurring. If you look at this, this is consumption sectors relative to production sectors since 1994. And what I try to show here is equal weighted S&P, healthcare, staples, and discretionary relative to equal weighted S&P energy, materials, industrials. Dollar cycles have always been about 7 years, since almost 40 years. And this dollar cycles captured here is like the 1993-94 cycle up to 2002, and then the 2002 to 2008. And you would argue that this 7 years since '08. Why do I think that '08, not 2011 here, was the actual takeoff point for the dollar? One, oil, which moves inversely to the dollar, peaked at $145 a barrel in the summer of '08 in June, and so did the dollar bottom. Second, Fed artificially through QE1, 2, and even to a degree 3, pressed down on the dollar. And if you were to look at the real effective exchange rate or purchasing power parity dollar, they all bottomed in June of '08. So let's say the dollar's up 7 years, showing signs of a peak, as are these stocks, consumption relative to production, which have rolled over. And on a momentum basis, this is the year-to-year change of the relative strength line above. They've definitely rolled over. So the problem for the market is we don't yet have the global production, energy, material, industrial, cyclical trade working, because we don't have enough global GDP, but we are not able to take up any further the somewhat overvalued healthcare staples discretionary trade. So we have to dig deeper now into the dollar. There are two dollars that matter. The Fed publishes both, and we update them in real time, and that is the broad dollar, which is all 25 countries, of which 18 or 57% weighting is emerging market, And then the major dollar, which I've been showing heretofore, and that is these 7 major economies like Europe and Japan and the UK. Let's look at the broad dollar, which is all 25, and what does that tell us about the future? Before we leave the subject of the major currency dollar, if we look at U.S. 10-year yields minus the 10-year yield of the major countries, the G10 ex-U.S., which are described in this thing here, I mean Canada, France, Germany, Italy, etc., the difference in our yields minus the major currencies' yields, which is this blue line, is only at a level that justifies the current level of the red line, the major dollar. So you're looking at the tallest elf in the forest, and the major currency doesn't matter now. What matters is this divergence since mid-15, where the broad dollar, which included EM, skyrocketed on weakness in China and emerging markets and short covering of a global dollar. A lot of emerging market countries borrowed in dollars, and they were short essentially, and there was a risk of their implosion along with China. The risk-on rally September 28th to recently was the pullback in the broad dollar, and then the recent weakness is this bounce. We think that the broad dollar will continue to pull back and rejoin this flattening emerging major currency dollar here. So what we really look at to gauge both the cyclical trade, the producer sector trade, the market's risk-on, risk-off posture, besides the broad and major dollar dynamics, is oil. Oil is interesting because of the asymmetry of the trade. It points to positive asymmetry, meaning your upside's more than your downside in reasonable dollar scenarios. Since 2008, if you were to do the broad dollar upside down, so that's minus 20 and plus 20, if the broad dollar correlates extremely tightly with oil year-to-year change, this is Brent year-to-year on a normal axis plus 100, minus 70. And so what you find is that that's because of zero rates by the Fed in the fourth quarter of '08. They equalized oil versus money. Neither pays an income, so they correlate with each other. And so on a reasonable scenario of minus 5, 0, and plus 5 for the dollar, you're looking at plus 35%, 15%, and minus 5 on Brent oil. That's the positive asymmetry. To put it in a chart, this green line here, as I've said, is the broad dollar. And if that were, since it's March 2015 kind of peak there, were to get to plus 5% on the dollar, then Brent, which was 55 on March 13th, would be down 5% to 52. That's your downside. A base case scenario might be a flattening of the green line, which is the broad dollar, just kind of flattening here. And that would be $63 a barrel, up 15% on Brent on a flat dollar. Again, there's your 0 flat dollar, there's your plus 15 Brent. Now, in an optimistic scenario, you might have the $55 Brent rise as high as 74 on a simple 5% decline to this dot in the green line. So from here to here. And that's a huge rally for the commodity. So I look at that and the dollar as a gauge of risk on off, and if it works on the global GDP, we're good. If not, then the deflation could spread, China could join the devaluation game, euro and yen would be cornered, the dollar would soar, earnings would fall, and we'd be in trouble. So we need global GDP today, and that's why this pregnant pause is so unnerving. But we're positive on them, and we think that we're going to get the global cyclical trade. If you require further disclosures, please go to Stifel.com. Thank you very much for listening.